Welcome and thank you for joining today. This is Colin Tierney from SageWorks Marketing, and we're very excited today to have you all with us. We have a guest presenter, as you know, Professor Damodaran from NYU Stern School of Business. So I'm going to give a very brief introduction. If we go to the next slide, here is a couple tips. We are taking questions today. There will be a formal Q&A session at the end of the presentation. Also, we'll be sending the content from the presentation and a recording of it to anyone who registered afterwards. So if you have questions, I encourage you to submit them. It's a good-sized audience today, so I expect a lot of questions, and it'll be great to get a conversation going. Let's go to the next slide. Just a very quick introduction on SageWorks. If you haven't heard about us, we are a software-as-a-service company located in Raleigh, North Carolina. We've been around for about 20 years now. We serve professionals in the business valuation industry as well as accountants and also banks. So we've been creating software solutions for quite a while, and if you have any questions, I'm not going to go into great detail today, but you're welcome to visit our website, sageworks.com, or if you're particularly interested in valuation, you can take a look at valuation.sageworks.com. Both of those websites have additional resources, white papers, old webinars, other things that you can read and take a look at. If you have any questions, you'll also find our contact information on those pages, and you can reach out to us at any time. If you go to the next slide, I'd like to introduce our presenter. So you probably have heard of him already. I've certainly enjoyed watching his videos and reading his articles on his website. If you have a chance, I highly recommend taking a look at his site, following him on Twitter. He is, in many ways, in my opinion at least, a true thought leader, someone who is an expert in his field, and you can hear his points and see his writing both in the classroom and also in financial news, someone who is an expert and knows so much, and I'm so happy to have him today to bring some of these ideas to life and bring some new ideas that I think all of you will enjoy. I do have to say that he is a guest of SageWorks, and is that his views are not necessarily the views of our company or our employees, but I have looked at the presentation and I can tell you that it's a good one, and I think that you will all enjoy it. So I encourage you to listen and ask questions, and definitely follow up with us if you have any questions after the fact. We're very excited to have him here today, and so I'd like to turn the presentation over to Professor Damodaran.
Thank you. Okay, so it doesn't get any easier than this, because I'm sitting in my office in a chair looking at the camera, and you know, I didn't think teaching could get this easy. I almost never sit down when I teach a regular class. And I'm glad that Colin added that that disclaimer about SageWorks, because at the end of this session you're probably going to be pretty pissed off. And I hope you just get pissed off at me, because this is really, I mean, my job is to kill sacred cows, and that sounds strange coming from an Indian, but that's basically the way I think about what I do. But I love talking about valuation. I love talking about valuation from the big picture perspective, and last year, for instance, I gave a talk on narrative and numbers, about how to connect stories to valuations, which I enjoyed immensely. And this year, I'm actually going to talk about cost of capital. The AMR, the CFA keynote is going to be on cost of capital, which is about as deep into the weeds as you can get. But there's a third topic in valuation that I do like to talk about, because I think it is central to why valuations go bad so often. And I really think that valuation processes often yield bad outcomes. And that is, the process by which we do valuation often results in bad valuations. Let me give you a story to kind of bring this home. About 6 months ago, I got a call from the head of an M&A department at a major investment bank. I won't name the bank. And she said, will you be willing to come in and talk to my bankers about how to do valuation better? And I think my answer surprised her, because I said, I would, but it's pointless. And she said, what do you mean it's pointless? I have a bright analyst. Don't you think they can learn how to do valuation well? And I said, teaching them how to do valuation is easy. Building great valuation models is easy, but it's pointless, because you built so much bias into the process here that you're going to get bad outcomes no matter how well people understand the process of doing valuation. So what I'd like to talk about are three elements to that process of valuation that I think get valuations into trouble. And I'd call this the Bermuda Triangle of valuation. And let me back up. And you've all heard the legend of the Bermuda Triangle, right? I mean, this is the triangle supposedly in the middle of the Atlantic where ships and boats and planes go in to disappear. And in the Bermuda Triangle of valuation is where valuation first principles and good sense goes to disappear. And the three sides to this Bermuda Triangle are first bias and our unwillingness to accept the fact that when we sit down to value a company, whether we like it or not, we bring our biases and preconceptions into the valuation. The second is uncertainty. And the fact is that as human beings, we deal with uncertainty in very unhealthy ways. We think of uncertainty as a bug. We try to get rid of it, when in fact uncertainty in valuations is a feature, not a bug. And the third is something which I think has become an added problem, especially in the last couple of decades, which is it's become so easy to build complex and detailed models that complexity is starting to turn on us. So let me take each of these elements and give you my perspective. And as I go along the way, if you have any questions about anything to do with these three issues or in general about valuation, just put those questions down. I mean, even if I don't get a chance to answer them during the course of this session, somewhere along the way, I will find a way to answer them. So let's get the game started. Let's start with valuation bias. In an ideal valuation, here's what's supposed to happen. You're supposed to sit down in front of your spreadsheet or a model or whatever you decide to value a company on with no priors about the company, a blank slate, and value the company based upon the data and the information you have and come up with the value and then decide how much to pay for the company. I wish that were true because the reality is very different. In most cases, when you sit down to value a company, you almost never start with a blank slate. In fact, let me give you a couple of stories to bring home how that this is not something I say about other people. This is true for me as it is for everybody else. I valued Microsoft every year since 1986. I mean, that's 29 years in a row. And I'll have to make a confession. I've never found Microsoft to be a cheap stock. You name the price, I found it overvalued at that price. Strange, right? One of the great success stories of equity markets of the last part of the last century, I wouldn't have touched it one step of the way. Now, I could give you access for every single valuation of Microsoft I've done over the 29 years, and you could dig through the numbers looking for clues as to why I found Microsoft to be overvalued, and you'd be looking in the wrong place. If you really want to find out why I valued Microsoft the way I have, all you have to do is actually visit my office. You come into my office and you look around, you're going to see lots of computers, and every one of them has an Apple on its back. I've been an Apple user since 1981. I still have the first Mac 128K in my office. It's sitting up on top of the top shelf there. Right? And to me, Microsoft has always been the Darth Vader of technology. I mean, if you're a Star Wars fan, I'm not talking episode 4, 5, 7. I'm not talking Anakin Skywalker, Darth Vader. I'm talking about Darth Vader. I have a lot of bad thoughts about Bill Gates. I mean, anybody who thinks Control, Alt, Delete is a great idea is not my sense of fun. And when I sit down to value Microsoft, all the bad thoughts about Bill Gates come bubbling up to the surface. So guess what? Valuation, you constantly come to forks in the road and you get to pick high growth or low growth. With Microsoft, it's a no-brainer for me. Low growth, who'd buy this rotten product? High risk or low risk? High risk, one virus away from blowing up. By the time I make my choices and I get to my end value, the value is almost predestined. I know I'm far too biased to value Microsoft. You know the other company I'm far too biased to value, but I do anyway? It's Apple. I love the company too much. I love its products. I've always liked it. And that shows up in my valuations as well. In fact, when I first valued Apple on my blog almost 4 years ago, I made about half my posts was to tell people not to trust my valuation. I said, don't trust me. I love the company too much. So whether you like it or not, your preconceptions and priors about a company come into the valuation with you. Here are two additional things I can add on that. One of the things you're often told when you sit down to value companies, find out as much as you can about the company. Read up everything you can on the company. There's a plus to that. You learn more about the company, but there's a minus. The more you know about a company, the more you read what other people think about a company, the greater the potential is that you're going to get biased before you sit down to value a company. There's this fine line you got to follow in what kind of stuff you read. If you read a lot of opinion about a company, you're almost going to bias your valuation before you get started. Here's the other thing I'll add. If you hang out too much with the management and the owners of the company, it's going to be very difficult for you to have an objective valuation of the company. You play golf with the CEO of a company, it's almost impossible for you to give me an unbiased valuation of a company. The closer you get to the management of a company, the more biased your valuations become. And if your numbers come from the management, I'm afraid your valuation is doomed even before you begin. That's about as biased a source as you can get. So the reality is, in most valuations, instead of valuing the company first and then deciding what to pay, people decide what to pay, then they go looking for justification for that number. That's when they might come to you and say, look, I want a valuation, when in fact what they're asking you is, I've already decided what to pay. Can you give me some way of justifying what I've already decided to do? It's not the way it's supposed to be, but it's a reality we face. So let's think about where this bias comes from. The first is, as human beings, and this is where a lot of behavioral finance stuff helps us, we know we're inclined to first herd behavior, which is we tend to stay with the crowd. I know we all try to think of ourselves as contrarian, but the reality is we are drawn towards a crowd. And with publicly traded companies, the number that most biases valuations is actually the market price. Let me explain. Let's say you sit down to value a company. Let's say you come up with $100 per share. The stock's trading at $150. And the stock goes to $200. Whether you like it or not, your valuation is going to get sucked up by the price. In fact, when people come into my valuation class, I warn them. I say, look, when you first start valuing publicly traded companies, don't be surprised if the market price acts like a magnet, sucking your value towards it. Because when you're uncertain about yourself, when you're uncertain about what you're doing, the safest place to be is where everybody else is. And that's where the market price is. The second is what I call hindsight bias, which is if you've known what's already happened, it's very difficult to have an unbiased valuation. It shows up in a couple of places. One is in Harvard Business School cases. I have never used a case to teach valuation. And there's a simple reason. Not only are there little kabuki dances where you know what the outcome is even before you get started, but in a sense, if it's a high-profile case, you know what the outcome is. So let me give you an example. If I gave you the Time Warner AOL case and I asked you to value AOL, I'll wager you're going to find that AOL was overvalued. Why? Because you know how it ended up. That's why I think cases are so pointless, is because if you're going to teach valuation and you know what the outcome is, your value is going to reflect that outcome. If you're doing legal valuation, this shows up in a different way, which is you're told to go back to 2012 or 2010. Act like you're in 2010. Act like you don't know what's happened since, and value the company if you're at that point in time. I don't know how you do it. I could never do that. If you ask me, if you put me back in 2007, say value a company, hey, but act like you don't know that 2008 is coming and a crisis is coming. I don't know how it doesn't seep into your valuation. Hindsight bias is one of the biggest dangers in valuation set back in time. There's also the power of suggestion. Now, when I talk to managing directors in investment banks, I tell them to be very careful about the suggestions they give their poor analysts. I've had managing directors hand over a case or a company valuation to analysts and say, I want you to value the company, and by the way, I think it's worth about $40. And guess what? Surprisingly, or not so surprisingly, the valuation comes back and it's exactly $40. In fact, I ran an experiment about maybe 5 years ago where I had two valuation sections one semester, and I created an IPO for them to value. It was a new IPO, and I said, you know, I want you to value this IPO. With one class, I gave the IPO numbers, but I mentioned nothing about, you know, what I expected the offering price to be. With the other group, I gave them exactly the same numbers, exactly the same company, and I said, you know what, I think the offering price is going to be roughly $25 per share. Just threw it in there. 25 was, it wasn't an unreasonable number, but I just wanted to throw it in there. So once the classes came back, and there were like 30 groups in each class valuing the IPO, I put up a distribution of what each class found. The first class, where I did not throw out that suggested number of $25, the valuations were centered around 15. In the second group, when I threw out that $25 and I looked at the distribution of values, guess what? They were centered around 25. In fact, when I value IPOs, and I've made this a practice over the last 5 years, I try to value them in the minute they file their prospectus. So whether it's Facebook or Twitter or Alibaba, I try to value them the minute they file their prospectus, but before the bankers set their offering price. And here's the reason. The minute I find out what the offering price is, whether I like it or not, it starts to seep into my valuations. And there's a third factor, bias. And this is the great untold reason, which is if somebody's paying you to do a valuation, I don't care how honest you are and how objective you are, bias is almost certainly going to follow. In fact, I have an add-on here, which is your bias in evaluation will be directly proportional to who pays you and how much you get paid. I'll give you a story to back this up. It's about 20 years old. A company called Lynn Cable. AT&T had this option to buy Lynn Cable at an appraised value. So the option, time for the option to exercise comes about. AT&T goes out and hires Morgan Stanley to value Lynn Cable for them. Lynn Cable goes out and hires Lehman Brothers to do exactly the same thing, to value the 49% so they can sell it to AT&T. So Morgan Stanley works for the buyer, Lehman Brothers works for the seller. Two investment banking teams go to work. They work their discounted cash flow models or whatever else they use. One comes back with $105 per share. The other comes back with $155 per share. And guess who came back with 105? It's Morgan Stanley, because they work for the buyer. Lehman came back with 155 because they work for the seller. You could have called that without even seeing it, but here's, I think, the tricky part. If you looked at each valuation standing alone, I wouldn't have blamed you. You said, this looks like a pretty good valuation. Look, it's got the cash flows, it's got assumptions, it's got scenarios. But the bias there came from who you work for. And with portfolio managers, this bias often shows up in a different way, which is if you already own a stock and you try to value it, you're going to kind of push your value up because you want to justify what you've already done. Or if you've gone short, you're going to push the value down. I mean, as some of you know, I've been a skeptic on Twitter for a long time, and I just bought Twitter last week when it hit 27. And I'm afraid that now when I value Twitter, the fact that I own it is going to bias my valuation up. Again, it's human nature. It's not because you're a bad person, but if you're paid for a valuation, it's almost impossible for you to be unbiased. I mean, one reason I don't do expert witness work is not because I find myself, I'm too noble to do it. I think it's great money if you can do it. But I know that if I am working for one side as opposed to the other, it is going to, whether I like it or not, seep into my valuations. So those are the sources of bias. And if you ask me, how do you bias evaluation? This is a template of tricks you can use. I'm not suggesting that you do it in a bad way, but it happens already. Might as well be honest about it. I mean, if you think about it, to increase the value of a company, I've got to either increase my cash flows, reduce my discount rate, or push out when I make the company a stable growth company. So if I'm looking for any tools I can to increase value. So here are some of the ways in which if you want to increase value through the discount rate, you might do it. One is to use a target debt ratio, especially if it's much higher than the existing debt ratio, with using the same cost of debt and equity, because that's going to push down your cost of capital. You can use a much lower equity risk premium. You can use a lower beta. I mean, you know the levers that you can push. In fact, one way to differentiate those people who are good at valuation from those people who are not, often is in how well they can hide their biases. If you're really good at valuation, you can hide your biases in very subtle assumptions. If you're not that good, then you're much cruder about the way you bring your biases in. But if you look at this table, you can actually see that almost everything we do in valuation is contaminated by bias, because these are choices we make. And we can be delusional and say nothing about this is subjective, but it's all subjective, they're choices. With private company valuation, there's almost an additional layer of bias that enters in, given what you do after you tell me you're done. What I mean by that is after you tell me you're done with the valuation, go a little crazy. You add premiums, you subtract out discounts. In fact, I tell people, you tell me what you do after valuation, and I'll tell you which direction your bias is. Now, I'll give you a couple examples. You go in M&A houses, where the objective often is to push up the value because you've got to justify the unjustifiable, the 30% premium. There's a lot of premium in it. There's a synergy premium. There's a control premium. And by the time you add 4 or 5 premiums, you're up at the number you need to justify the price. Private company valuation, and I'm speaking about this as an outsider because I'm not obviously in the appraisal business, you guys must have a bias towards pushing numbers lower. I mean, you have a lot of discounting. I remember the first time I went to a private company appraisal conference, it was about 25 years ago. And I gave my keynote early in the morning, and then I looked at the remaining 3 days of the conference, and every single session had the word discount in it. There was a controlled discount. Don't ask me how this happened. The controlled premium became a controlled discount, a minority discount, a liquidity discount, or an illiquidity discount. There might be two different discounts depending on liquidity and illiquidity. The private company discount, I guess that you got too desperate to even name the discount, but essentially there's a heck of a lot of discounting going on to kind of push the value down, because that, again, might be the bias that comes out of who pays you to do the valuation. So just to give you an illustration of how bias can be slipped into valuations, this is a valuation I did of Facebook on May 17th of 2012. This is right after the prospectus was filed. I came up with a value of about $25.39. In hindsight, it was a hopelessly low value, but I made my assumptions and I made the best judgments I could. And to come up with the value, I used a revenue growth rate of about 40% for 5 years. I made it a Google wannabe. In fact, that's what I patterned my revenues on, is on how well Google did. I did assume that their margins would come under pressure and that they would have to reinvest $1 for every $1.50 in revenues. With those three key assumptions and 11% cost of capital, I come up with $25.39. Let's say I'm the investment banker and I've decided that I want to price the stock at 38. If I want to price it at 38, the 25.39 value doesn't back the price, so I need to push the value up, right? So here's a very simple way to push up value. I kept pretty much every assumption as is, but I left the pre-tax margin where it was and assumed that they could get $3 of revenues for every dollar of invested capital. Seemed like relatively minor adjustments, right? I also let the company earn a much higher return on capital forever after year 10, and nobody looks at that forever assumption anyway. With those three changes, when I revalue the company, I come up with $39.32. But let's say I was a pessimist and I wanted to show you that Facebook was worth 1/3 of what the offering price was. Easy to do. All I did was I changed the margin to 31% rather than 35%. I made the company reinvest more, and in steady state, I assumed that they would earn their cost of capital. With those three assumptions, the value I get is $14 per share. From 26 to 39 to 14, with relatively minor tweaks in the assumptions, and assumptions that people often don't even look at. Who looks at the reinvestment assumption? I mean, you might focus on revenue growth and margins, and if you're focused there, I'm just going to move my bias someplace where you tend not to look. And if I'm careful enough, I should be able to hide a lot of bias in my valuations because there are so many places to hide. Now you say, what if I use multiples and comparables? Right? It's just as easy to introduce bias because there are three levels, so three steps to doing a relative valuation, or a pricing as I prefer to call it. First, you got to pick a multiple, right? And think of your choices. You could pick an equity multiple, an enterprise value multiple, or a firm value multiple. You can have an earnings multiple, a book value multiple, a revenue multiple, or even something as specific, a number of users, number of apps. So you get to pick the multiple, right? You get to choose the comparables. I know that, I know they're supposed to be companies just like yours, but you tell me what those companies are. In fact, one of the easiest ways to kind of uncover bias in evaluation is when an analyst says, these are the 15 companies that are comparable to mine. I ask them a very simple question. Did you start with those 15? Because the truth is, in most cases, you started with 40 and you shed 25. I'd like to know the 25, or look at the 25 you threw away, because those are going to reveal more about your biases than the 15 you left in. If you let me pick a comparable, if you let me pick a multiple and you let me pick the comparables, I can pretty much tell you whatever story I want about a company. Okay. Your cholesterol is 300, not too bad. Relative to people who had heart attacks in the last week, you look really good. I just have to pick the right comparables to tell whatever story I want to tell. So when you think about picking a multiple, choosing comparables, and telling a story, you can pretty much spin any story you want to spin about any company you want if you give the analyst complete degrees of freedom. So next time you pick up an equity research report, before you look at the buy, break apart the equity research report. If the analyst is using EV to EBITDA, ask yourself why. Why EV to EBITDA? Why not EV to invested capital? Why not EV to sales? If he shows you 12 companies and claims those are the 12 comparable companies, then why those 12? Why not those 24 other? And when he spins a story, think of how much the story is spinning towards an end recommendation. The reality is the analyst really was started with a buy recommendation before he even looked at the numbers, and these are the mechanics he's using to get to justify what he's already decided. So how do you deal with bias? There are lots of bad ways, and here are three that I find rampant in appraisal and valuation. The first is denial. I've heard people say, I use only numbers, I'm being objective. As if numbers make you objective, as if numbers give you precision. The fact that you use numbers means absolutely nothing. I used only numbers for the Facebook valuation, but I was able to bias the valuation up and the valuation down. So we're in denial, and we don't even want to seem to face up to the fact that we have a problem. If I get past the denial, I get false outrage, which is, I'm a professional, how dare you accuse me of being biased? Hey, you're human. Human beings are biased. Accept the reality. Almost every one of the alphabet soup of different valuation, I have lost track of the different groups that do ASA, AICPA, the CFA. I mean, every one of them. If you look at the way they describe their profession, is that they're unbiased, objective people, and that's what they're going to push towards. And finally, I'm sick and tired of the stamps of approval we get on our values. In fact, the more I see the word fair, the more I'm convinced that you're trying to be biased. For instance, fairness opinions in M&A. Why do we waste our time on those? It's make work for appraiser day. That's basically what it is. Even the worst deals ever done come with a fairness opinion to back them up. Legal fair value. Again, it's almost an oxymoron. Okay? There's a legal value, but I don't know what's fair about it. It meets all the legal criterion for fair, but it doesn't make it a fair value. In fact, I tell people, do you want to do a legally justifiable valuation, or do you want to do a good valuation? The two are very different things. And of course, there's the greatest oxymoron of all, accounting fair value. Sounds absurd. I mean, make up your mind. Do you want to do accounting or do you want to do valuation? In fact, I'll make a statement about accounting fair value that I can back up pretty simply. There's nothing fair or value about accounting fair value. It's really pricing. In fact, if you look at the description of accounting fair value, it's about coming up with a number that somebody in the marketplace will pay for that asset today. That's pricing. Why we call it value and why we call it fair, I have no idea. But somehow we think if we can get that stamp of this is the fair number, that we can fool ourselves into believing that it's become fair. So what am I proposing? First, I think we need to build up processes that minimize bias. We can't make bias go away, but we can build processes that minimize bias. In other words, we need to shelter people from the preconceptions and priors that come in, not load on more to them. So if you remember 20 years ago, investment banking or sell-side equity research at investment banks went through a crisis. They went through a crisis because for a period, sell-side equity research analysts were almost required to bring an investment banking business into investment banks. I know there's a Chinese wall, but people are climbing up and down that wall. That essentially expands your bias. So if you're a sell-side equity research analyst at an investment bank and you have a significant investment, corporate and investment banking income you're making from that same company, it's going to be very difficult for you to be unbiased. Second, be honest, at least with yourself. I know that you have a job to do, that you have clients, and you can't be exactly open and transparent about your biases. But be honest about your own biases, because I think that if you're not, after a while, the delusions become real. Third, in statistics, there's a branch of statistics called Bayesian statistics. In Bayesian statistics, here's what you're required to do. You're supposed to reveal your priors before you do a study. In other words, you need to tell me before you run a regression what you think you're going to find in the regression. And in Bayesian statistics, what you report are your priors. This is what I think I'm going to find. And then after you've run your regression or whatever study it is, you can say, this is how my priors shifted. Wouldn't it be neat in valuation if we're required to do the same thing? Imagine an equity research analyst saying, well, before I even looked at the numbers for this company, I thought it was a great company. And now let me look at the numbers to see if my perception has shifted. And finally, I think we need to be more transparent about motives. We need to let the world know if we have other axes to grind, other agendas, what those agendas are. In other words, if I'm being paid to do valuation, the world needs to know that I'm being paid to do the valuation and how much I'm being paid. Because I think that's the only way we can bring this to the surface. So that's the first stop, is bias, and you can already see how damaging it can be to valuations. The second big issue in valuations is uncertainty. As human beings, we don't deal very well with uncertainty. I give people the analogy of, driving down a highway way out in the middle of nowhere. You have no idea where you are. You come to a fork in the road. Your cell phone's broken down. Your GPS is not working. You don't know whether to go right or left. You're facing uncertainty. And ask them what they will tend to do. And ask them, no, what are the choices you have? The first is you can pull your car over to the side and hope the uncertainty resolves itself. I'm not even sure what that means. Will the roads kind of combine into one? No, but that's the first. The second is you can come up with rules of thumb, which have no basis in reality. You can say, well, 20 years ago I came to a fork in the road. I went right, and it turned out to be the right choice. Maybe I should go right again. You're in a different part of the world. That old rule makes no sense, but those are called mental shortcuts. We use them all the time when we face uncertainty. The third is you turn to your spouse in the other seat and you ask her, or him, which way should we go? I mean, he or she is just as out to lunch as you are, but this way you pass the buck. If something bad happens, it's not my fault. You told me to go that way. So the way in which we deal with uncertainty as human beings is we deny it, we outsource it, we push it behind the curtain, we hope it goes away. But the way, as I described at the start of this session, uncertainty is not a bug in valuation, it's a feature. Because when I think about valuation, I think about answers to 4 big questions that I need to get answered to value a company. The first is, what are my cash flows from existing assets? So I have investments on the ground. What are those investments throwing off as cash flows? Second, what's the value that I expect added by future growth? Remember, growth by itself doesn't create value. It's growth with excess returns that create value. So what's the value that I expect to see added by future growth? Third, how risky are my cash flows? And fourth, when will my company be a mature company? Those are the 4 questions I need to answer whenever I sit down to value a company. Think of when those questions are easiest to answer. If I gave you a Coca-Cola or a Procter & Gamble, those companies are easy to value. These are mature companies. You know what they do. Value them is relatively simple. But think of valuing a young company. Here's my valuation of Twitter, for instance, just before they went public. It's October 27th of 2013, again, just before the bankers put an offering price. And if you remember Twitter, I mean, it was a company with relatively little substance when it went public. It had $500 million in revenues. It was losing money. It had lots of promise, lots of potential, whatever that means. And this was my valuation of Twitter, where essentially I made the small revenues into big revenues. The revenues, as you can see, go from $500 million to almost $11.5 billion in 10 years. The operating loss becomes an operating profit. I estimate how much I need to reinvest to make this magic happen. I come up with cash flows and I discount them all back at a cost of capital of about 11%. The value that I get is about $9.7 billion for the operating assets, about $18 per share. If you look at those numbers, you say, well, you made those up as you went along. How the heck do you estimate numbers like this for a company with so much uncertainty? Very easily. I just have to make my best judgments. Will I be wrong? Absolutely. So what I'd like to actually do is think through this process of uncertainty, and rather than hide from it or say you cannot value a company if there's a lot of uncertainty, I want to start breaking down uncertainty. I mean, when you sit down to value a company, uncertainty comes at you from every conceivable direction. One thing I suggest people do is they make a laundry list of everything they're uncertain about. And you know what? This list is going to get really long, but it's cathartic. Just list out the 35 things that you're uncertain about. Then start putting the uncertainties into boxes. What kind of boxes? I mean, first, I classify uncertainty into 2 kinds, estimation uncertainty versus economic uncertainty. Estimation uncertainty comes from the fact that you haven't done your homework well enough, that you haven't looked at the data already, that you can do better by spending more time on your models and estimating the inputs. Economic uncertainty is out of your hands. It comes from outside. Building the best model in the world is not going to make economic uncertainty go away. And let me give you a very simplistic example to do this. If you had to value a Greek shipping company today, would you face a lot of uncertainty? Absolutely. Almost all of it is economic uncertainty, nothing to do with estimation uncertainty. In fact, this should be a huge load off your shoulders because it says there's only so much you can do about dealing with uncertainty. You've got to build the best model you can, and then you've got to let go. I call this the karmic let go, which is essentially say there's some things I can control, but most of this uncertainty has nothing to do with me. Second, uncertainty can be micro uncertainty or macro uncertainty. Micro uncertainty is uncertainty you face about your company, its business model, its products, its management. Macro uncertainty comes from outside, interest rates. What will Janet Yellen do? Will rates go up? Will exchange rates change? And the reason it's good to separate the two is micro uncertainty shows up in your cash flows. Macro uncertainty is what you reflect in your discount rate. In fact, if you have public companies, that's the only uncertainty you reflect in your discount rate. So if you take a biotechnology company, huge amounts of micro uncertainty, right? Because the products they come up with might have to work their way through the FDA pipeline. Tremendous uncertainty about whether you get approved. But almost all of the uncertainty is at the company level, micro uncertainty. You can have a low discount rate for a biotechnology firm because the macro uncertainty, the uncertainty you feel about this company being added to a portfolio, is far less. I also have a third grouping. You can have discrete uncertainty. Things can happen or not happen, or continuous uncertainty. I give the example of exchange rates. Let's say you have a currency, which is a fixed exchange rate. No uncertainty, right? It's fixed. The exchange rate is the same every day until it's not. When you have a devaluation, you have a big change. As opposed to a continuously traded currency. If you have a US company with European operations, every minute of the day, as the euro-dollar exchange rate changes, your earnings are changing, your cash flows are changing. We're very good at dealing with continuous risk in finance and in valuation. We're not very good at dealing with discrete risk. If you ask me to value a Venezuelan company where nationalization risk is up front and center, traditional discounted cash flow models are not very good about dealing with that. So that's the first step, is think about where the uncertainty comes from. As I said, the unhealthy ways of dealing with uncertainty are myriad. And in fact, let's see how this plays out in valuation. When there's lots of uncertainty, what people do is they go into denial. They say, "What? No, I don't see any uncertainty." Or they go into paralysis. I can't value the company, there's too much uncertainty. If you look at what's happening in the social media sector, at the VC level and in the public marketplaces, people have essentially thrown up their hands and used the excuse of there's so much uncertainty, I can't value the companies, so why bother? The second is mental shortcuts, rules of thumb. I'll pay $100 per user. Why? Who knows? Works as well as anything else. That's a mental shortcut. No basis in reality, but it lets you act like there's no uncertainty. Third, if you're really uncertain, you go where everybody else is going. You buy stocks when everybody else is buying. You sell stocks when everybody else is selling. Look at the Chinese markets. There's no fundamentals driving that market. It's all hurting all the time. And when uncertainty comes front and center, that's exactly what you should expect. The fourth is you outsource. You ask an expert. You call in McKinsey, you call in Goldman, you ask them to value the company as if they have the secret ingredients that make uncertainty go away. So here are some healthy responses. And I wouldn't claim that I came to these healthy responses in a moment of brilliance. These are learned skills that I've developed over time as I sit down to value these young companies. And here are 6 things that I find stand me in good stead. First, less is more. Fewer items rather than more items. Second, as I go through these companies, creating these amazing companies on my spreadsheet, and you can create through some really amazing companies. I call them dream state DCFs on your spreadsheet. I have to create internal checks to make sure that I'm not creating a company that cannot exist. Third, this sounds like a strange thing. We spend incredible amounts of our time coming up with discount rates in discounted cash flow valuation. You say, of course we should. It's a discounted cash flow valuation. With young companies, with lots of uncertainty, the discount rate is the least of your worries. So don't sweat the discount rate. Spend more of your time on the earnings and the cash flows. Fourth, some of your assumptions don't matter. They offset each other. In other words, you worry about inflation. Inflation shows up both in your cash flows and your discount rate. If you're wrong and wrong in the same direction in both, you're going to be okay. Fifth, don't forget Econ 101, Stat 101, Math 101, just because you're in Valuation 101. You can't rewrite the first laws of economics. And finally, rather than run away from uncertainty, face up to it. Take a look at it in the face. It's amazing how much more comfortable you'll start to feel and how much better you will get at dealing with uncertainty. So let me explain. Less is more. I mean, the way we build spreadsheets is we build them in incredible detail. We start with revenues and you start listing 16 different expense items. Please don't do that when you feel uncertain, because you have to estimate each of those line items. With Twitter, for instance, let me give you a very quick map of how I got the revenues, margins, and operating income in future years. I knew what the revenue was right now. It's about $500 million. The way I get the revenues in year 10 is I work backwards. Let me explain. Rather than go year 1, year 2, year 3, which is the way we're taught to do valuation, is move sequentially, I jump to the end of the game. I said, what do I expect Twitter to look like if it succeeds? And here's how I came to that judgment. I started off as saying, hey, how do they make money? They're not, I mean, I know they're a social media company, but social media is not a business. Advertising is a business, and it looks like that's a business, is online advertising. So the first thing I did was actually gauge the size of that market in total. And it took a little bit of work, but it turned out that online advertising in 2013, collectively, globally, was about 117 billion. Google was the biggest player, Facebook was the next biggest, and then you can see the splintering across the rest of the market. That's the total market. Now, online advertising is part of a much bigger market, which is the advertising market, and at least in 2013, if you looked at online advertising, it was getting to be about 20% of the market, but you can also see that it's growing over time. And it's sucking a lot of revenues out of newspapers and magazines, the print media in particular. TV advertising has held up surprisingly well. But what do I learn from this? I'm learning that not only is online advertising 20% of the overall advertising market, but it's growing. Taking those two pieces together, here's what I started with. I projected out what the total advertising market, total online advertising market is going to look like 10 years from now. Why 10 years from now? As I said, you've got to get an end vision before you start building back. And if I assume a 3% growth in total advertising and that online advertising will continue to climb from 20 to 30%, my total advertising market in 10 years is about 206 billion. Even if I'm optimistic, it's about 300 billion. So really the question with Twitter becomes, what percentage of this market do I think Twitter can capture in 2023? That's what drove my end game. And I made the assumption, it's my assumption, that Twitter would be about 6% of the market. You think, why so low? Because to me, Twitter will always be a secondary advertising medium. Secondary because its strength is its weakness. It's this nice compact medium, 140 characters. But it also means your ads have to fit in 140 characters, which effectively also means that Twitter can never be a Facebook or a Google lead advertising. It has to be a secondary advert. That's in my story, that's what gave me the 6% market share. Now for the margins, again, I looked across the sector. The two most established players are Google and Facebook, one at 23 and the other at 30. I ended up using a 25% operating margin for Twitter. You're saying, how do you know? I don't. Those are my assumptions. And that's basically what you see back on page 21, is my revenue is going from $500 million to $11.5 billion. I give you this false sense of precision. When you look at the growth rates, it looks like I estimated them year to year. I effectively had the starting and the ending numbers. You know what? I really don't care what the numbers are in an individual year. So if you made a big deal about year one and said, I really think it should be 63%, I'd say take it. You want year two? Take that too. You give me the starting and the ending numbers in this valuation. You've essentially given me the valuation. With margins, again, I start with their existing margins, close to zero. I push those margins up to 25%, again, over 10 years. And I adopt some very simplistic rules to get from where I am to where I need to be. So essentially, I'm taking stepwise linear increments to get from where I am to where I need to be. Again, if you don't like that, I'll let you take the margins over in years 1, 2, and 3. You take the product of those two numbers, you get the operating income by year. For the first few years, I don't get a tax benefit. Why? Because I've got losses carrying forward. I build those losses into my after-tax operating income. And that's the building block for the bulk of the valuation. So if you look at the valuation, those are the big numbers, and they come from my end vision for the company. Am I making a lot of assumptions? God, am I making a lot of assumptions? Doesn't bother me, not in the least. I have to make those assumptions. Let's talk about internal checks. One of the problems often in valuations like these, where you're projecting out revenues and you're projecting out margins and you're projecting out reinvestment like I am as separate inputs, is sometimes you might not be aware of it, but you might be creating a company that's internally inconsistent. What I mean by that is you might be creating a company with incredibly high margins and returns on capital or incredibly low ones. So one way I keep check of my own assumptions is I keep track of what happens to my invested capital each year. Because here's something we forget. What you put in as reinvestment in free cash flow to the firm is how much your invested capital changes on a year-to-year basis. Every year I take my own reinvestment, add it to the invested capital, and I come up with my expected invested capital by year. I divide my projected after-tax operating income by that invested capital to come up with what I call an imputed return on capital. You can actually build this into any discounted cash flow valuation. It's an eye-opener. Eye-opener in what sense? In the case of Twitter, my ending return on capital is about 22.39%. I'm okay with that. It's much higher than the cost of capital, but given the kind of business it's in, I can live with that. What would I have not been able to live with? A 223.9% return on capital in year 10. If I'd seen that, I'd have to go back and revisit my assumptions. In particular, if I have 223.9% as my return on capital, I've reinvested too little over the next 10 years. I have to go in and lower my sales to capital ratio. In other words, you can use your own valuation to provide feedback to you when you make assumptions that are internally inconsistent. Build in those internal checks. It's a great way of keeping your valuation in check. And as I said, the key number here was that sales to invested capital number. And you can see that looking across the spectrum, and I use 1.5 for Twitter, I was actually being pretty optimistic. That's much higher than either Facebook or Twitter in 2013, much higher than the sector. And that's effectively what's driving that reinvestment number. Third, I'll make a confession. When I did my Twitter valuation, I think I spent about 2.5 hours coming up with the cash flows, maybe 5 minutes on the cost of capital. Why? First, it's almost all equity. So the notion of cost of debt and debt ratios so there's no point for me finessing the cost of debt, looking up a rating, doesn't make a difference. It's almost entirely cost of equity. And the cost of equity, of course, comes from, equity risk premium and the risk-free rate, which have nothing to do with Twitter, and the beta that I use for the company. I use the beta for online advertising companies, and I threw in a little bit of info services because Twitter does sell their tweets as data. And I came up with the beta 1.40, and I didn't spend too much time on it. Here's why. My ending cost of capital is about 11%. That's around the 90th percentile of cost of capital for U.S. companies. It made sense to me. Risky company, 90th percentile. I was done. If you push me and said, make it 95th percentile, that'll push me to 12%, I'd use the 12%. It's not making or breaking this valuation, so why am I wasting time on it? So younger a company is, the less time you should spend on cost of capital, and recognize that that cost of capital will change over time. Fourth, I'm a big believer in consistency. That when valuations go bad, it's because you have internal inconsistencies. I'll give you a couple of examples. Especially as we globalize and we start moving across currencies, we have to be careful that we match up the currency in which we do the cash flows with the currency in which we do the discount rate. Here, for instance, I have a valuation of an Indian company in Indian rupees and US dollars. I'll give you the good news as I move from rupees to dollars first. When I value this company in dollars instead of rupees, my discount rate becomes much lower. You say, this is good. Lower discount rate, higher value. Well, not quite. Because when I move from rupees to dollars, my growth rates also decrease. And here's why. The only reason currencies matter in valuation is because they bring in different inflation rates. I've moved from a high inflation currency to low inflation currency. Guess what? My discount rate is going to get lower, but so are my cash flows. And the end value that I get for Tata Motors is exactly the same, whether I value it in rupees or dollars. That's currency. That comes from currency consistency, being consistent about the way you estimate cash flows and discount rates. The second level at which I check for consistency is if your cash flows are after debt payments, after interest, after principal, the cash flows to equity, your discount rate has to be a cost of equity. If they're pre-debt cash flows, free cash flow to the firm, cash flows before debt payments, then the discount rate has to be the cost of capital. You'd be surprised at how many times I see discounted cash flow valuation that mismatch currencies, mismatch cash flows to equity and cost of capital. And if you do a mismatch, all is lost. I don't care how much work went in. Finally, the terminal value number. Big number, right? In valuation, we make it a bigger number than it should be. We make a big deal about that growth rate in perpetuity. I actually have taken 3 companies here, 3M, Tata Motors, Amazon, 4 companies, Amazon and Twitter. And with Amazon and Twitter, it's true. My value increases, my terminal value increases as I increase my growth rate in perpetuity. With 3M and Tata Motors, that doesn't happen. The reason is very simple. The big assumption in your terminal value is not what growth rate you use forever, but what return on capital you assume goes with that growth rate. If you assume a return on capital equal to the cost of capital, which is what I did for 3M and Tata Motors, the growth rate doesn't matter anymore. The other very simple rule that I follow in my valuation that people take issue with me on sometimes is I cap my growth rate at the risk-free rate. I could give you an elaborate backup of that using the Fisher equation, but I'll give you a very simple reason why you should do this. If you've underestimated one, you've got to kind of keep your valuation on the other. Let me give you, and let me follow up. I hear people saying that they think interest rates are too low. I don't know. I don't have the hubris to make that judgment. Let's say you're right. Interest rates are too low. If interest rates are too low, your discount rate is too low, right? And here's one way to keep it in check. If you've underestimated your discount rate by using too low an interest rate, then I want your growth rate to be capped at the same number. What will get you into trouble is if you use a nominal growth rate in your cash flows that reflects what you think will happen to the economy, and then use today's risk-free rate, which is not consistent with what you think about the economy, you're going to overvalue the company. So if you look at the caps I put on my growth rates, they're always set at the risk-free rate because it allows me to keep my valuations internally consistent. And finally, there is this one issue that I run into in valuation that I call the macro delusion, which is we tend to get so focused on valuing individual companies that there's nobody doing the supervision across companies. Let me explain. You have 20 social media companies. Each of them is being priced and valued based on this big online advertising market, right? So if you sat on the valuations of each of these 20 companies, they're all using the same end game. Look, there's this big market out there. The market is so big, we should have a high price. Let's say that you're able to convince markets about this big online ad market, and you get high prices as a consequence. My question is, collectively, is the market big enough to sustain all of you? To try to answer this question, about a year ago, I took every social media company that's publicly traded today. And then I estimated from the market price what the imputed revenues would have to be in 2023 to give you the current price. And then I added up those imputed revenues, and here's what I got as my end value. $319 billion. These are all online advertising companies. And you know why that should scare you? If you go back a few pages and you look at my best case scenario for online advertising collectively as a market, I think it was 305 billion, 300 billion. And here I am at 390, and that doesn't even count the companies lined up, ready to go, Snapchat, the companies that are potentially also going to come to the market. I call this the macro delusion. And it happens because people use stories to sell companies. They use the same story. It's not because people are crazy. They're rational, but collectively they're making a mistake. And finally, face up to uncertainty. 30 years ago, you just said, what the heck are you talking about? Today, if you can spend a few $100s, buy Crystal Ball, which is an add-on to Excel, you can convert your base case, static, point estimate valuations into simulations. Sounds fancy, right? But all you're doing is replacing those single numbers I gave you for revenue growth and margin and sales to capital and cost of capital with distributions. That's exactly what I did with Twitter. You see, what do I get out of this? You get a distribution of value. This is my distribution of value for Twitter based on my entering assumptions. You think, what's the point of it? Look at the spread of the distribution. You're right, it reflects real uncertainty. It's not because your valuation is not good. In fact, if I showed you a valuation of Twitter and the distribution was centered around one number, it's a lie. There's real uncertainty here. And what it basically means is when you look at a price for Twitter, let's say it got as high as $60, $76. If it estimates 76, is it possible Twitter's worth 76? My answer is, of course, anything is possible. If you ask me, is it probable, I'd go back to this distribution. At a $76 stock price, there's probably a 5% chance it's undervalued. At a $27 stock price 2 weeks ago, and I've updated these valuations over the last 2 years, there's about a 52% chance. Hey, I'll take the 52% chance. Investing is a game of odds. All you can do is tilt the odds in your favor, and these distributions give you one final tool. So bias, uncertainty, let's close the process off because we're getting towards the end. Our valuations are getting more complex. They're getting more complex because our companies are getting more complex. Our companies are getting more complex partly because the tax laws are getting more complex. In fact, we can trace the blame back wherever it needs to go, but we are valuing more complicated companies than we used to. We have a lot more data than we used to. I mean, you have Capital IQ, Bloomberg, FactSet. I mean, you have incredible data at your fingertips. Okay? Cross-sectional data, historical data, macroeconomic data, data that will cost us weeks and weeks of time, 10 years ago, 20 years ago, 30 years ago, we can pull up. And third, it's so easy to build big models now. Far too easy. You have tools, you have macros on top of macros, you can build apps. So those three things are pushing in, and in addition, there are two other forces that are pushing towards more complication. The first is some analysts, at least, I'm not suggesting this is true for analysts, want to create complicated valuations because it intimidates people. This is a way of saying, look, I know valuation. Look at this model. It's so complicated, you have no idea what's going on. We use numbers as a shield rather than as a way of seeking out valuation. And in The other reason we create complicated valuations is we want to dot every I, cross every T. This way, we've created these complex details. Nobody can ever accuse us of not doing due diligence. So whatever reason, complexity is here. It's coming from globalization. It's coming from shifting macro risk. It's coming from accounting standards becoming more complex. And it's coming from lots of different places. And wherever it's coming from, here's how it manifests itself. Every week I get at least one email referencing a valuation approach. Have you ever heard of this approach, the FAQA approach, ECBA approach? And I have no idea what. And at the risk of sounding incredibly stupid, I usually email the person back saying, I'm sorry, I have no idea what ECBA stands for. Could you give me an explanation? And after they describe it, I say, you know what? This is all wine in a new bottle. It used to be called this 10 years ago, this 20 years ago, this 30 years ago. But there are these acronyms floating around that scare the heck out of me. Our valuations are getting longer and more detailed. I've seen valuations run 30 pages, 500 line items. And the what if and scenario analysis has to stop. It's getting way out of hand. Hundreds of scenarios. What if this, what if that, what if this and that. And after a while, you lose sight of what the end game is, which is to make a better decision, not to create more scenarios. So here are some unhealthy responses to complexity. The first is what I call input fatigue. I've seen this happen with analysts sitting in front of really complex models requiring dozens and dozens of inputs. You get to about the 23rd input. You basically are tired. You say, okay, the 24th input says, what was the inventory 5 years ago? Part of you wants to go look it up, but that part's too exhausted to get out of the chair. You say, enter a random number. Let's move on. It's amazing how quickly the random numbers roll out. Input fatigue. Basically, you get tired and you start entering garbage. And it's great looking garbage. That's the scary thing. The second is the model becomes a black box. After a while, you're not sure who's running whom. Are you running the model? Is the model running you? And the third is these models become so complex that after a while, you just suspend common sense. You're convinced that the model is right and you're wrong. Okay? So what are some healthy responses? I am a great believer in the principle of parsimony. Never estimate more inputs than you absolutely have to. If you can value a company with 3 inputs, don't go looking for 5. You can value it with 2 years of forecast, don't do 10. That's why I'm not a great fan of models that actually come with standardized boxes, because then I have to build a model for the worst company you can value, and then you're taking a simple company and taking it through the process. Second, when in doubt, go back to first principles. So if you're saying, what tax rate should I use? Don't make up numbers. Don't sit around as a committee and discuss it. Think about what you need to estimate, what you're trying to estimate, and it's amazing how often the answer will come to you. Third, in every valuation, there are probably 2 or 3 variables that drive the value. Find out what those 2 or 3 are. Focus on those 2 or 3. In my Twitter valuation, it's revenue growth and margins that drive the valuation. Everything else is a side story. I shouldn't be wasting my time on cost of capital if that's not the case. So I'm going to end with a slide that some of you might view as insulting, but it's a slide that I start my class with, and it's a slide that I actually put myself in. You've all heard the legend of lemmings, right? They all run into an ocean, commit collective suicide. We always wondered why they do it. And I don't know the answer to the question, but I think that of why they do it. But I think one reason is because you come and say, they must know something that I don't. That's why they're running into the water. It's human nature. When you see the stock price go up, even if your valuation doesn't justify the price, after a while you start second guessing yourself. They must know something that I don't. One reason I do valuation is I know I'm going to be a lemming because I'm human. I'm going to join the crowd. To me, valuation, if you go back to basics, gives me a life vest. That's why I'm the second to last guy in this group. See this guy over here? That's me, a lemming with a life vest. There's a lot of established practice in valuation, and I won't go through them, but there's a whole list, entire books on what you can do. This is how you come up with the discount. This is what you add to your discount rate if you have a small cap stock. Just because everybody else does it doesn't make it right. So my end suggestion is be honest with yourself. Be open with yourself about what you're doing. Question everything you do constantly. It's easy to fall into bad habits, especially as things change around us. So I hope this session has been useful in some extent, perhaps even provocative. But I will try to answer any questions you might have on these, on anything to do with what we talked about today, or anything else you might have.
All right, this is Colin again from SageWorks. Thank you so much. We have a quick question for you all. We're going to launch a poll here in a second, just to give you a little context for our company, and then we'll go right into the Q&A. I'm actually going to introduce one of my colleagues here, Aaron Lively. He's the division manager for our valuation solution. He's going to give you a very brief summary of what we do so you can understand the context for today's presentation. And then we will launch the poll question and get right into the Q&A. So Aaron, if you don't mind.
Yeah, first off, I just want to thank Professor Damodaran. That was exceptional, and I hope that everybody was able to take good information from that. Part of our job here at SageWorks is to provide great content to both our clients and also prospective clients. And this is one of those things that we do on a regular basis to try to put good information out there in the BV world, and I hope everybody benefited from that. Our software platforms are definitely geared towards giving relevant information in the CPA market, the business valuation market. We do have a software platform that helps people put a structure in place for doing business valuations, which is geared towards more of putting that structure in place, allowing you to focus on numbers instead of worrying about developing software in-house. If that's something that you would like to hear more about, we do have a poll question coming up right after this where you'll be able to indicate that. But again, thank you to Professor Damodaran, and I hope everybody had a good time on the webinar. Thank you so much. All right, thank you so much. We have our results to that. I am going to turn it back over to Professor Damodaran to answer some of the questions that came in through the webinar. And this will be your chance to speak with him directly, so if you do have questions, now would be the time to ask those questions.
All right, so let's see. We have a few questions here. I'll go ahead and read some of these off, and if at any point anyone wants to enter others, please go ahead and do so. Looks like the first question is actually one that pertains to doing valuations in countries outside of the United States. This is an interesting one. Do you consider an uncertainty as an opportunity even in a developed country like Ukraine, where uncertainty is a usual thing, actually, and shown in absence of information in most spheres of valuation? For example, in Ukraine, apparently they do not have stock market history or statistics. So this question is asking, how would you apply uncertainty in a situation where you don't have the financial history?
With my valuation class, I have some very simple advice that I give to my students. I say, go where it's darkest. And I try to follow that practice when I value companies. And in fact, I remember in November of last year, I did a blog post with that exact title, Go Where It's Darkest. And I valued 3 companies. I valued Vale, I valued Lukoil, and I valued Petrobras. And I picked those companies because they were commodity companies in a commodity market that was obviously collapsing, lots of uncertainty. In emerging markets, Russia and Brazil at that time, which all were going through their own contortions, and in currencies where the currency was actually was being devastated. So I said, hey, in companies like this, you know exactly what's happening. People are not even trying. There's so much uncertainty. So you took a Ukrainian company or a Greek company, my guess is nobody's even that there's a lot of uncertainty. But what's your choice? This is an uncertainty that you made up. This is the reality you face. All you can do is do the best you can in making estimates with the information you have. The information might be incomplete. But you can always make an estimate. Historical data is nice to have, but it's not a requirement. In the case of Twitter, I really didn't have any historical data, right? I had a financial statement from last year, but it was kind of meaningless. There was very little there. I still could make a judgment, but here's what I have to remember. I am going to be wrong 100% of the time, and it's okay. It's okay because I don't have to be right to make money. I just have to be less wrong than everybody else. And guess what? If I do my best to value Ukrainian company, I'm going to take that as a challenge, and I'm going to actually value Ukrainian company this semester in my valuation class. I don't have to be right. I just have to be less wrong than everybody else, and my odds of being less wrong than everybody else is probably going to be greater with a Ukrainian company or a Greek shipping company where nobody's even trying than it is with Procter & Gamble or Coca-Cola.
Thank you for that answer. We have a couple other questions here to go through.
Okay, go ahead.
The next question is, using different peers to estimate top-line growth and operating margins is not consistent, this person states. Doesn't it negatively impact your assumptions by, quote, randomizing those assumptions?
I'm sorry, maybe I misunderstand the word random, but what's random about looking at other companies in a sector? Those other companies that control the sector, their margins reflect what they're making. So I don't see anything inconsistent or random about, if I pick 15 companies randomly from FactSet and I pick the margins and use them, that would be randomizing. If I'm picking 15 companies in online advertising, look at what they actually make, I don't see anything random about it. I don't see anything inconsistent about it, because the question I'm trying to answer is, what would a mature company in an online advertising business make as a margin? So why not look at Facebook and Google as my visions of what a company that is mature in this business will make? So I'm not sure where the inconsistencies are in there, or what's random about that comparison.
Thank you. We have another question here. This one is, when you have a company with multiple share classes and one is entitled to 6 times the dividend and 100 times the voting power or share, how do you parse out valuation per share per class?
So it's entitled both more dividends and more voting rights. Usually if you take away voting rights, you compensate with more dividends. Sounds like you have real second-class citizens at this company. Here are the things. First is the dividend difference is a cash flow difference. So basically, if you want to value it, you value it at the cash flow level. So the company with the highest, essentially it's like you get 6 times the cash flow that the other guy gets. That's going to be easy to value. The voting rights is a little messier because it really depends on what the expected value of control is at that company. And I'm not using it in the banker sense of just add 20% to whatever you estimate as a value. To me, the expected value of control in a company is the difference between 2 valuations. The value the company has is the status quo value, and the value the company run optimally, with quotes around the word optimal. If you have a perfectly managed, perfectly run company, voting rights don't matter. But if you have a badly managed, badly run company, those voting rights are going to come up as a difference between those 2 valuations. I have a paper on the value of control that might help on this, because that's exactly the question I was trying to answer, is when you have multiple equity claims on a company, voting shares, non-voting shares, high dividend shares, low dividend shares, how do you start allocating equity value? And it's not easy to do because you have options built on top of options, multiple layers to value, but it can be done.
We have a couple other questions here, and please let us know if we're taking too much of your time. I think everyone really appreciates hearing from you. The next question is, you mentioned poor comparable company choices as a manifestation of bias. Do you suggest using more companies in the analysis to weed out bias, or focusing on a few companies that most match the valuation target? What is your general target for finding comparable companies?
I would be more inclined to go with a big sample over the small sample, because if I let you pick 3 companies just like yours, I am totally and completely screwed. I mean, you're going to find a way to bring bias in those 3 companies. So I'm a great fan of more data is better than less data when it comes to comparables, because it's more difficult for you to play the bias game with 100 companies and with 3 companies. So I would argue that going with a bigger sample is better there. But the reality is, if your bias is strong enough, then you're going to find a way to bring that bias in no matter what I make you do.
Here's an interesting one that plays to the theme today. If the price came out of the valuation, the price that resulted from the valuation is not what you expected, should you go back to the valuation or do more research to justify the price?
First, let's not use the word price. Price is what the market sets. Demand and supply. Value is what you've come up with. So you valued a company. The value that you've come up with is not the value that you thought you were going to come up with. And the question is, should you go back and do it? Unless you're clairvoyant that somehow knows the value of something before you even sit down to value a company, it's incredibly dangerous to start off with strong priors on what the value should be and try to reverse engineer your valuations to deliver it. Having said that, I would say 60% of all valuations are exercises in reverse engineering, where people decide a number and then they try to back into that number, come hell or high water. So my answer is, if you're doing that, you're really not valuing companies. You're really spending an incredible amount of time and resources backing into a number that you picked right off the top.
So I think we have time for 2 more questions here.
Okay.
I'll read the second to last. This is risk versus uncertainty. Is there a bias to view risk as negative only? For example, risk of not achieving revenue versus the uncertainty of revenues being higher or lower that are projected.
You know what, rather than dance this dance of risk and uncertainty, I'd say do a simulation then. That way you have the upside, you have the downside. It's all showing up in your simulation. The only thing I would add about risk as in the context of discount rates is in the discount rate, the risk you should be reflecting is not that uncertainty about revenues, but about, it's really designed for macroeconomic uncertainty. But to me, if you really want the upside and the downside to show up in your valuations, go the distance, put in distributions for your assumptions, let the value kind of reflect both the upside and the downside. One reason I bought Twitter is I think that the downside is more constrained than the upside, partly because of where the company is in terms of its pricing. So that's one of the factors that drove it, is that there's a lot of uncertainty, and the uncertainty here is actually at this price more likely to deliver an upside surprise than a downside surprise.
All right, here's one more. In your examples, the resulting cap rates were somewhat low. Would that be true for small private companies?
Do I want to open this can of worms? I don't think I will engage in the process. I think that you're right. These are cost of capital for public companies. For a publicly traded U.S. company, 90% of companies have cost of capital between 6 and 11. If you ask me, and this is my gut at the moment, you ask me what the cost of capital for private companies would look like, I would say it would be closer to 12 to 16, 12 to 17. And here's the reason. It's not that private companies are riskier per se, but because the owners of private companies don't have the luxury of diversification, they have to bring in all risk into their discount rates, or a big chunk of the risk, rather than just the macroeconomic risk. So that makes a big difference in what the discount rate is. Having said that, I'm not a great fan of the build-up approach to cost of capital because, again, you start off with a number in your head and say, I'd like to see 23%. You're going to get there if you keep adding premiums to your discount rate. So I think it's true private companies will have higher costs of capital, but the reason it happens is not because they're inherently more risky, but because the people buying these private companies tend to be less diversified. So if you have a private business to sell to a public company, I would say the cost of capital is going to look very much like what you saw for Twitter, 10, 11, 9, 8. So it really depends on the private company and what you're valuing it for.
Thank you. So in the last minute here, one other question came in, and I think I have to read this one. I think the audience will appreciate hearing your response, and then we'll call it a day here. So this uses a fun business buzzword, and I've seen some of your presentations in response to using buzzwords and valuation, so I'd love to see how you handle this particular question. So it reads, how do you determine if some of the companies in the data have synergy in the transaction?
How do you determine whether they have synergy? Synergies can be real, right? I mean, let's face it, it can be higher revenue growth. My problem is not with synergy per se, but it being used as what I call a weapon of mass distraction. There are words that people use to kind of throw you away from the numbers. Things like strategic, synergy, real options. They're not using them because they want to put a number on them. They want to use them because they want to say, don't worry about the numbers, the deal's going to make sense anyway. So they can be real synergies in mergers. I'm not going to be crazy and say they're not. My problem is that people don't put numbers down for the synergy before you pay for it. At the right price, I'd pay for synergy. At the wrong price, it doesn't make any sense. So of course there can be synergies. It just, I mean, I think we need to do our homework and estimate what the value of those synergies are.
Well, thank you very much again, and thank you on behalf of everyone who's listening in. We really appreciate your time and these ideas and insights and having real-world examples to tie back to some of the information and process around doing evaluation. So thank you so much, and we look forward to hopefully having you again soon.
There was listed 34 questions that I did, I mean, many of which I didn't get to. Will there be a way that I can see these questions after we're done, or?
Yes, we can facilitate that, absolutely.
Thank you very much for listening, and you know how to find me. I'm the easiest person in the world to find. So if you have any questions anywhere about any of the things in valuation, just type into Google search my name, and luckily I'm not that common a name, so you should be able to find me easy enough. Thank you.